The Fed just pumped $135 billion into the financial system, and you've probably heard nothing about it. You're not going to see this on the nightly news, but believe me, it is the single biggest reason why the markets are acting so weird right now. $135 billion. Let that sink in for a second. It's a staggering amount of money, and it was quietly pushed into the markets in just a matter of days. By the time we're done here, you'll understand exactly why stocks keep climbing, when for so many of us, it feels like the economy is completely broken. Okay, let's get real because this is probably your life. On one side, you've got rent that's sky high, inflation that just won't go away, and maybe those student loan payments are back. Your wallet is feeling the squeeze. But then you flip on the news, and the stock market is partying near all-time highs. So how can both of these things be true at the same time? Well, that disconnect, it's not in your head. And it is definitely not an accident. So what is going on? For the last year, all we've heard from the Fed is how they're fighting inflation by keeping interest rates high. But here's the secret. The real story isn't about interest rates at all. No, they didn't cut rates. Instead, they flipped a switch on a hidden engine, using tools that most people have never even heard of. Okay, think of it like this, because this is the most important part to get. Interest rates, that's the brake pedal for the economy. The Fed has been very publicly stomping on that brake. But liquidity, which is just a fancy word for the amount of cash washing around the financial system, that's the gas pedal. And right now, the Fed is secretly, and I mean secretly, tapping the gas while telling everyone their foot is still on the brake. So how are they hitting the gas? Well, it's through this thing with a super boring name, the reverse repo facility. Now, don't worry about the jargon. The idea is really simple. Just think of it as a special parking garage for cash that's run by the Fed. When banks have extra cash, they park it there to earn some safe interest. That takes money out of the system. But, and here's the absolute key, when the amount of money in that parking garage goes down, it means all that cash is flowing back out and into the market. And has it ever gone down? Oh yeah. A little while ago, this facility was holding around $2.5 trillion. Today, that balance has plunged to under $600 billion. We're talking about almost $2 trillion in liquidity that's been unleashed back into the financial system. That, my friends, is the rocket fuel. And what happens when you pour a rocket fuel on a fire? Well, the connection between this flood of liquidity and the price of assets like the S&P 500 is about 80%. The link is undeniable. As this cash pours in, asset prices just keep rising. It's the hidden tide that's lifting all the boats in the market. But hold on, here's the part that almost everybody gets wrong. If you think the Fed did all this just to pump up your 401k or give Wall Street a boost, you're missing the much, much bigger story. This was never really about propping up stocks. Let's get to the real reason. This huge cash injection wasn't an offensive play to juice the market. Nope. It was a defensive move to prevent a complete meltdown in a market that's way more important than stocks, the U.S. Treasury market. So what was the emergency? What was so scary that the Fed had to act so aggressively, but do it so quietly? Well, it all comes down to one absolutely mind-boggling number. $7.1 trillion. That is the amount of U.S. government debt that has to be refinanced, and soon. The government needs to roll over this mountain of old debt. But here's the kicker. They have to do it at today's way higher interest rates. And this isn't some problem for the distant future. Look at this timeline. We are staring down what people are calling a wall of debt that's set to hit us hard in 2025 and 2026. Now, for the government to pull this off, there needs to be a ton of cash, a ton of liquidity in the system ready to buy up all this new debt. If that cash isn't there, the whole system could just break. So here's the bottom line. The Fed saw this debt wall coming from a mile away. They knew they had to grease the wheels of the financial system to handle it. So they picked the quietest, least visible rescue possible, draining that reverse repo facility to inject all that cash without setting off the alarm bells and causing a total panic. Okay, so that's the big picture stuff. But let's bring it back home. What does all of this actually mean for your money? How are you supposed to navigate a market that's being driven by these hidden currents instead of, old school economics? All right, here are the key things to remember. First, when this much liquidity is being pumped out, just holding cash is like holding a melting ice cube. You're silently losing purchasing power. Second, all that cash has to go somewhere, and the first places it tends to flow are assets like stocks and, yep, even crypto. Third, and this is crucial, the real danger, the thing that causes huge market swings, isn't a bad inflation report anymore. It's when this liquidity gets taken away. So the single most important action for you is this. Don't fight the flow of liquidity. Learn to track it. So let's wrap this up. If you walk away with just one idea from this whole thing, I want it to be this. The Fed didn't actually pivot and give up its fight against inflation. It just blinked, quietly. And as long as this stealth liquidity is flowing to help the government handle its massive debt, big market crashes are basically on hold. They're not canceled, just delayed. The problems are still there. They're just being covered up with a giant pile of cash. And that leaves us with the most important question of all. The real question isn't if this quiet support for the market ends. It's when. Because when that liquidity hose gets turned off, the market is going to have to stand on its own 2 feet again. And that is when things could get really rocky. Understanding these hidden flows of money is honestly the key to navigating what's coming next. So if you want to stay ahead of the curve with more essential macro breakdowns just like this one, make sure you hit that subscribe button.
And one last thing, of course. Just a reminder that this content is for educational purposes only. It's not financial advice. Past performance doesn't guarantee future results, so please always do your own research and talk to a pro before making any big moves.